The following is a podcast conversation with Bruce Campbell, a man who has quietly shaped Canadian investing for nearly 5 decades. Bruce started his journey at CIBC, learning business from the ground up. From there, he helped manage what was then Canada's largest in-house pension fund at Ontario Hydro, worth $2 billion at the time. He went on to become senior vice president at Royal Bank Investment Management, where he and his team grew assets from 8 billion to 35 billion, managing some of the largest pension and mutual funds in the country, that is Canada, and delivering consistent returns through discipline, persistence, and sharp focus on fundamentals. In this riveting conversation, Bruce shares what it really takes to manage billions, the lessons learned from market cycles, from the dot-com bubble to the artificial intelligence boom, and the timeless principles behind compounding wealth. We discuss everything from how to start investing with just $5,000 to why free cash flow and management quality matters more than hype. If you care about building long-term wealth, managing risk, and thinking like a professional investor, this episode is for you. This is Inside the World of Portfolio Management with Bruce Campbell. And if you haven't subscribed, make sure you subscribe so that you don't miss when I bring in guests and share insights about how to build wealth in the future. Thank you and enjoy this conversation. Hello and greetings to the audience there. Today I have a very special guest, my now friend Bruce Campbell. Bruce is a very accomplished retired chairman and portfolio manager, and is going to tell us quite a bit more about his journey, some of the things that he would look at when he was managing millions of dollars for the clients. And I'm sure you are going to benefit from this conversation. So help me welcome Bruce. Thank you so much for making time.
No problem, Isaac. Good to be here.
Great. Bruce and we connected through my very close and special mentor, and I won't mention his name, but it's been a very rewarding experience getting to know you, Bruce, because once in a while when I have some ideas about what I'm planning to do in the stock market, I kind of like want to bounce them off with you and kind of like hear the downside of what I think.
Yeah, the downside in particular, given how much the stock market's been running in the last 12 to 24 months. So protecting your downside if you've made money so far is obviously something everybody should be doing.
That's fantastic. So why don't we start off by you, Bruce, telling us about your journey, how you started and ended up managing billions of dollars of clients' money.
Yeah, we have to go back to the 70s, which would be before you're born.
Yes.
So a long time ago, but everybody starts somewhere. Well, I was just telling you before we started, I was working at Ontario Hydro internally in the 70s, just as a finance general trainee, and an investment job came up for the pension fund, and there were 40 applicants, and there were 39. The other 39 guys all had an MBA.
Wow.
And I have a master's degree in economics, and that made me different. And I ended up getting hired, and the fellow told me afterwards it's because I was different that I got the job. I obviously could talk on my feet and do all of that, and it was an entry-level job, so
Wow.
none of us had any stock market experience at the time. And so It was a great place to learn because it's a pension fund. There's only the one client. You were managing the pension fund for the benefit of the hydro employees. And it was a $4 billion fund in 1979. I think that's roughly right. And that was big for the time. And so we had access to all of Bay Street's information. And I started by looking at bank stocks, in fact, and writing them up for my boss and talking. And so I had a mentor who was 15 years older than me, and I was early 20s. And so he'd had a bunch of experience before at an insurance company. So it was a great place to learn. I was there 8 years, and he left and went over to Royal Trust before it was purchased by Royal Bank, and was there 2 or 3 months. And one of his employees left, and so he asked me to come join him. So I did, and at that time they were, and now it was pension funds, but this was in the pension side, it was other people's pension funds. I probably shouldn't mention names, but big steel companies and universities and all names you would have heard of for sure, and including a few I ended up managing money both in Newfoundland and BC and most of the other provinces. And so we were 8 billion in assets when I arrived. We've jumped forward to 1985, and the track record was extremely poor. And the reason, it's interesting, the reason it was poor was that they had an investment committee like back in those days. And so what would happen is the guys would get all together and they would end up talking and having a recommendation, but then they'd have to wait for the investment committee to approve it, which only met once a quarter. It was just terrible, like pre-internet too, right? So you'd have a good idea, but you wouldn't buy it for 3 months. So the market would have already, even though there's no internet, if it was a good idea, the market would have moved up. And so then they'd buy it after it had moved up. So we just changed that whole system. Unfortunately, all those fellows lost their jobs. Some of them, they kept their jobs, but they got shuffled over to sales or somewhere else. They weren't in investment management anymore. So my boss, who had brought me over, and myself and 2 others, there were 4 of us. So we were good at it. We didn't have that antiquated system. If we had an idea, we bought it in 5 minutes, not in 3 months. And it took 3 or 4 or 5 years, but we turned it around. And by the end of that 5-year period, we were the #1 equity pension managers in Canada. And eventually I stayed about 12 years. At the end of the 12 years, we'd gone from 8 billion to 35 billion.
Wow.
Part of the reason I left was that at 35 billion, that included bonds in there, but we had gotten so big that I used the analogy of the Queen Mary versus the tugboats, which was, then I started my own firm in 1999. And by then, the 35 billion was so big in Canada that it had ceased to be fun, in the sense that the TSX 60 is the 60 largest stocks.
Yes.
We owned every single one of them. It just was the proportion. And
Yes.
so it was harder to outperform because of you're victim of your own success. You have lots of money. So that was great. But then we were starting from scratch with a small firm and doing it for individuals. Our little tugboat could run rings around the Queen Mary because we had flexibility. So, and just applied the same structure that I had learned even as a pension manager successfully for individuals. And over time, that was successful. My firm it's based in Oakville, Ontario. It's still there running, but as you can see from the gray, I've now retired, and it's still successfully applying the same things. In fact, of the 4 managers that are there, 2 of the fellows I worked with at Royal, and our back office and our CFO, or I should say there now that I'm retired, they're all ex-Royal people. So we just applied those same premises, and I can talk about I can talk about that if you think that's of interest as to
Yes.
the process and the structure of how to put together a portfolio that you'd like to think that will last over time.
Well, that's a remarkable career, Bruce, because I can imagine I see a lot of people trying to complete CFAs, trying to so that they can become fund managers. And I see a lot of them posting that I have failed. It seems it's extremely difficult, but it seems like you have had a very rewarding career. And I'm going to pick your brains on a lot of things because a lot of the people I interact with, they really want to know. Let's say, I know, like for your firm that you retired from, the minimum amount is like $500,000, and very few people can have that kind of money. So, yes. So,
Yes, exactly.
I'm thinking about if I have some audience who maybe have like 5,000 or 10,000, what would you say would be sort of things that they should look at for them to start to at least have a fit in the investment arena?
Well, I'll answer that, but I would start by saying when I started the firm, our minimum was 150,000.
Okay.
So it was a lower level, and then we raised it to 300 and then to 500 as we got successful. Then just think of it as if you're a professional money manager, it's the same work to do 150,000 that it is 15 million. And
Okay.
so when that's the case, you can raise the minimum, and you do, and most firms do, obviously, when you get to a certain size. But we, in fact, even up to recent times, what
Yeah.
tended to happen is our clients have children and they want to help them, and so we would make exceptions for the children, and the
Okay.
children often had small amounts to start, and so
Okay.
I'm familiar with
Okay.
trying to do that kind of thing for a smaller dollar amount. One of the things that Robinhood's the US example, but Wealthsimple or something like that in Canada,
Yes.
where now with if you do Wealthsimple and they don't charge you commission to buy something, you can, even for a small amount, it probably still doesn't make sense to own 40 stocks if you have $10,000.
Yes.
And there's ETFs now, there's more ETFs. That's a trivia. There's more
Exchange
ETFs than
traded funds.
stocks on the New York Stock Exchange. Just crazy. You can buy double and triple anything almost, and most people should stay away from that because it's so risky. So I would say some obvious things. If you're pretty young, right, say 35 and under, then you've got at a 7% return, money doubles every 10 years. So
Yes.
if you're 35 and you're going to work till 65, you've got 4 cycles. So just think you start with $10,000 and you make that 7%, it's going to go 10, 20, 40, 80. So
Yes.
your money's going to be, if managed well, is going to be 8 times what you start with at 35 without putting anything in. And
Yes.
so if you have that long, you don't have to day trade or try to do that, particularly if you're not that knowledgeable. So that's one of the things back to my pension days where we were paid not to take big chances. We constructed a way to look at, there were 14 subsector groups in the Toronto Stock Exchange, and let's pick one that's pretty small, like a couple of percent. Well, that would tell you, we in fact had a self-imposed rule that we couldn't be more than double whatever the weight was in the exchange. So
Okay.
we really liked real estate and it was 2%. We could own 4, but we would never own 20. And energy's moved all over. It's back up closer to 20 these days, but it's been over 30 at its peak. It's been under 10. And so you really, 20% energy, you really probably should never own 40. You should have some exposure, and so those groups give you a guide for maybe what you should be doing, remembering that the Canadian exchange is very much different than the US one, where we're lower consumer because things like McDonald's are here, but 100% owned by the US parent. We have very much more energy and gold and
Yes.
materials and very much less technology. So that wasn't the case 30 or 40 years ago to the same extent. So you can mix, you want some US exposure, look at the US weights and do that. So coming back to the $10,000, instead of buying, as an example, instead of buying five banks, the five major banks, you can buy an ETF that holds, in fact, there's a financial ETF that holds all the banks and the insurance companies in one holding. And so that would be something I'd highly recommend that you can do. You can buy a gold ETF.
Yes.
Probably you should keep that to less than 5% of portfolios. And if you had 3 or 4 or 5% gold, it's doubled this year. So you might have 10. You should probably start to do some trimming as you go. And so the whole thing is to manage your risk as you go, and you can do that by looking at those weights, because it gives you a guide that you don't get too far out in left field. As far as you could wake up, if you had bought just gold and tech a year ago, it would be great, but you'd wake up now and have a whole portfolio of that. You could implode and be down 20 like gold's there a couple days ago here. You finally had a pretty big retreat and most of the stocks were down 10% in a day. And you'd still want some exposure, but you probably, if you'd had gold, like in my personal portfolio now, I have some gold, but I've been trimming a couple times as we've been going up here to leave some exposure.
Yeah.
So it just gives a sense of you can do that now with a smaller amount. I would recommend staying away from mutual funds just because of in Canada in particular, it's a high cost delivery system. So if you have zero knowledge, sure, you could go to a bank and buy an equity mutual fund, but the average fee is kind of 2.5%, and that's tough. And these markets have been unusual in that they've been good, but the very long-term numbers are going to be 6 or 7% return. And if you're paying 2.5, then you're talking about your return net being 4.5, and that's a big cost. So if you can get knowledgeable enough and find a system kind of how I'm describing, then you can do it yourself and save the 2.5%. And you learn as you go as well, right? Obviously, by being involved and reading. And nowadays, with the internet, there are ways to get research on a group or a stock that you're interested in. If you want to do that, it's available. Back when I started, oh my goodness, again, I did not have a PC on my desk until 1984. So, and then you could build an Excel model and change things of what earnings estimates and stuff. It was like it started to change the world. There was no zero commission brokers to go to or anything. And in fact, we'd have information advantage because it wasn't instantaneous on the internet. We could talk, it wasn't inside information. It was just a second level of information that retail couldn't get. And so we liked something, we could buy it because we were working, we'd hear about something and it would be in the paper the next day. That doesn't happen anymore. So you do have to you've got a regular job. You can't be there like an investment professional, but you can certainly do what you can and find sources of information, even amazingly Twitter or X now. There's some bad information out there for sure, but there's a lot of info. If you can find out 10 or 15 really good sources of guys over time that actually helps to be a shortcut for people who don't have any other source of info.
That's interesting. So when you were talking, Bruce, I just remembered, I think that was 2 days ago, I stayed up late. Sometimes I'm just thinking about something, then I dig deeper. And one of the people that I like to read their writings about is Warren Buffett. And I found a letter, you probably may have seen this, that he wrote. I think it was published in Forbes in 2000, but I think just before the dot-com bubble. And he was talking about the expectations of the returns that on average, a lot of people, they tend to wrongly assume that they are going to make maybe 20% or so per year. And while on average, it's extremely difficult, and you were talking about the 7% return versus corporate profits. And basically, it's a very famous like letter that he wrote about the US stock market. He usually doesn't comment like specific, but I found it very interesting. In particular, the fact that the US stock market, as an example, Bruce, you know this, it has been in a bull market. I think last year it was about 25%, if I'm right. And then the previous year it was above 20% return. So a lot of people, from what I've seen, from my conversations with people, they think it's very easy and it's gonna continue like that. It may, nobody can really predict the market, like the direction confidently, but I like to play it safe. So I like the fact that you, by design, you mentioned that you had a specific methodology of constructing a portfolio that you would have exposure to different sectors such as energy, gold. For me, sometimes I like to just have cash as a hedge to say if the market drops, then after doing research on specific stocks that I will be following more like a hawk, like a Wall Street analyst, then I get in, right? And I totally agree. You also need the information. You need to do the research and get the right information. So that's very interesting. I was just summarizing your very insightful recollection. Now, so are there like some, for lack of a better word, some unique secrets or unique things that the rich people or most people who would come to you to manage the fund do in terms of their mindset or the way they think? Because why is it that a common person doesn't do that?
Well, it's interesting you mentioned Warren Buffett, and he's got taken to task sometimes, but
Yes.
in the long term, always kind of proven that he's been right. Like back to 2000, the dot-com bubble, like if you something like Nortel, which was a
Yes.
famous, was $124 and eventually went bankrupt, but
Wow.
at $124, what it was assuming, if you looked at I'm going to throw out a discounted cash flow model,
Yes.
right, which is a model that uses the numbers to predict what the stock's forecasting. It
Yes.
was forecasting that the revenues and profits of the firm were going to go up 100% a year for 10 years.
Woo.
Like, so you just can't, and some of these AI companies and
Yes.
quantum computing, that's what it's happening again.
Yes.
Uh, and it can only end badly
Yes.
for a lot of them. There
Yes.
will be some winners in there. Buffett was the guy in 2000 that said, I can make no sense of this.
Yes.
I'll always remember the story. My wife and I had a pet cat at the time, and subsequent cats after that. And in 2000, there were two different pet food online companies that came public, and neither one of them had any business. But because they were online and it seemed like a good idea, the
Was the
stocks
time.
were crazy, they ultimately went under. And so people just piled into the idea, and that is happening again. And I think in the short term, the
Yes.
danger is for young people that you hinted at it.
Yes.
So 25% and 20%, I don't know the
Yes.
exact numbers off the top of my head, but it is something like that.
Yeah.
And so there are young people that have never experienced a loss. So they just think it's easy.
Yes.
Another quick anecdote, my young son, who turned 38 yesterday, when
Yes.
he was 10, I had a little portfolio. I have two sons, and they were 14 and 10. And I let them have a three stock portfolio, but I had veto power. And so they both, their first choices went up a lot. Kind of, one was a takeover and one was just my older son picked the laser center for laser eyes and it went up like crazy. So my young son, I've always remembered this and try to tell people, my young son said, Dad, when I grow up, I'm going to do what you do. We just pick a stock and it goes up and we make money.
Easy.
Like he didn't, the 10-year-old mind was,
Yes.
yeah, this is easy, right?
Yes.
It's not that easy, and it's probably going to get a lot tougher here.
Yes.
I don't know when
Yes.
and what the trigger is going to be to cause. We need some kind of pullback in the
Yes.
tech AI side, and the big seven are up a lot.
Yes.
And in fact, I did see yesterday that the equal weighted S&P is only up 4% for the year. So if
Yes.
you take out that's encouraging to me, actually, that there's a lot of value in non-technology. And Buffett always thought longer term we would revert to the 7% average.
Yes.
And if we're going to revert to the 7% average, like the last decade now is something like 11, not 7,
Yes.
that we're going to have another negative year at some point, and it'll be a big surprise to people. So if you have the right structure and you have some, and you're paying attention, don't just buy something and forget about it. You
Yes.
need to pay attention these days. It's not like when I started where you could buy it and semi forget about it because it would just slowly move. But now, we were talking about it there. Mr. Trump says something, and
Yes.
like on energy overnight here, sanctions on Russian oil, and boom, the world price of oil is up 5% immediately. So
Yes.
things happen now, warp speed as opposed to non-warp speed like it
And
used to.
you can imagine if you have the opposite side of the trade, right? And it
Right? Yeah.
goes the other way. So that's how things work. So I couldn't help but just imagine, like, just remember exactly what Warren Buffett was saying, because I like to read his letters. And as I probably shared with you, I traveled to Omaha just to have the privilege of seeing him a few meters away. And of course, I could have watched it online, but I just wanted that experience. And most of the things that he has said, they have come into fruition. And I also respected the late Charlie Munger, because his thesis that you should always look for businesses at fair value that are fantastic in terms of their free cash flows, in terms of less debt, being run by wonderful people. And I think that thesis has kind of stood the test of time. So I wanted to ask, so I wanted to follow up there. So what sort of insights are there? Some insights, like from some more like, is there a pattern like for people who would come with funds to say, because what I see, my thesis without evidence, Bruce, is that a lot of people I talk to, sometimes they are struggling to, they are living paycheck to paycheck, so they may not have money to save, right? So I think that's the other catch. Is there an insight into those people would say, like, do they spend less, do they create trust funds and have this generational wealth building mindset? Because I learn a lot by talking to people like you, because I think to build wealth also, there's the behavioral aspect. Like, if you delay spending, right, immediate gratification, and invest, probably if you do it well, you can build more wealth. So I'm like trying to get some insights into that.
Well, I mentioned that story about if you're 35 and you get 8 times your money at 65 at 7%. If
Yes.
you start at 25,
Yes.
that becomes 16 times.
Compound interest.
Like the magic of the numbers means the earlier you start, the better you'll do, even if you don't have a lot. And
Yes.
so one thing I always tried to, even to my own sons, and it is to say, okay, guys, don't have a lot of money starting out, but make the investment side as if it's a bill. Okay,
Mhm.
you can pick a number that you think you can afford,
Yes.
5% of your after-tax earnings, and that's a bill every month, and it goes
Yes.
into the investment account. And
Mhm.
maybe it goes in an RSP because then you get a tax deduction. And so the net cost would be 3.5 to 4% if you get a tax return.
Yes.
And so then if you do that every month, and you can set up an automatic debit, right, to go right to it these
Yes.
days. So if you do that, you say, okay, that's It's
Spend.
gone. It's part of retirement, but I can't. Yes, you could always stop it, but try to have the mentality that I can't stop it. It's important. And it doesn't matter if it's 5% of your salary and it's, I'm picking a number, $100 a month,
Yeah.
that'll start to add up. That's $1,200 a year. And even if you only do that for 10 years, that 12 roughly $12,000 that you would have put in will end up from 25, the 16 times multiplier, it'll be $188,000. And all you were doing was putting in 100 a month.
Yeah.
So when you get this age with this much gray, you have to look back and say, how did you do that? And one of the things is consistency. And if you're consistent, like Warren Buffett, using him as the best example of all time,
Yeah.
you will earn the 7, and maybe you'll earn more sometimes. And when you have a negative year, it won't matter so much because you had 20 and 25 and you'll get a -10 every once in a while. But if you look over the decade of it, in fact, you should always look at the -10 as an opportunity to maybe put more in if things are down. So that's another thing, is you're putting in 100 and you happen to get your tax return back and the market's down. Maybe you get $1,000 back. Maybe you needed to do the house or do whatever. But if you don't, put it in when at the bottom, and you'll even jumpstart your retirement funds a little more.
Fantastic. Now, let's move on to a bit more fundamentals of investing. So, how do you pick stocks? Like, what sort of things do you look at? Let's say I like to use the US because it has depth, and here at the Toronto Stock Exchange, we also have great companies as well. So it's universal. But I'm more like of a trade in the US, NASDAQ, and the New York Stock Exchange. So if you are to pick, because let's say there are 4,000 stocks that are listed at the New York Stock Exchange as an example, and NASDAQ, and you want to narrow it down maybe to 20 stocks, like what Warren Buffett likes to say, at least think of it. What are the 20 best ideas that you would have? You have, let's say, you have limited. What are the sort of things that you look at, and what have consistently enabled you to compound money at such a good return during your career?
I'd start off by saying if you do a screen, there's some exceptions, and you have to understand some businesses trade not on price to earnings or a PE ratio. They would trade on price to cash flow. And I'm specifically thinking of energy and real estate, where
Yeah.
depreciation's so high that the earnings aren't really what drives them. And so you can set those aside for the moment. The thing that I like to look for, and you have to do some work to it, would be free cash flow. And I think we've
Yes.
talked about
Another
that. You'd
case.
like to, and really the definition is, for people who don't understand it, really cash flow is earnings and depreciation and deferred taxes. So it's really the cash that the business generates. Then the free cash is after. You also want to look at the debt to cash flow ratio, because you can have cash flow, but you may have big interest payments. So free cash flows after the interest and after everything else and after dividends. So if you're paying a dividend, that's great, but all of that. So I'd love to have a company that, and there aren't that many of them, that are generating free cash flow in sizable amounts, because it means they can grow the business, they can make an acquisition, they can build a bigger plant, they can do those sorts of things. And in downturns, almost always the companies that get into trouble, it will be balance sheet related, right? They might have cash flow, but they have big obligations. And so it's free cash flow that you want to look at. Obviously, any company that you're interested in, you need to know what they do for a living. Is it cyclical? You could, energy and real estate aside, trying to think of something, lumber, that we have good companies in Canada that way, and there are Weyerhaeuser or some other big US ones, but it's a cyclical business, and they're price takers. They can't really set the price. It's the same way even in my pension days, we never owned airline stocks, because it's just they very rarely get free cash flow. When they do, it's time to sell them. You could make a cyclical run, but over time, it's just not that great a business, I think. And so it's difficult because they don't have free cash flow. That and the balance sheet and the cheapness. I mean, I look at the debt and the price to cash flow, but I'd also, if you're looking for things to dive deeper, the characteristics that you'd like, I would like the management to own stock and have
Also
their,
have the skin in the game.
yeah, and not just options, actually own holdings. Like one that just comes to mind, it's it's the largest natural gas stock in Canada, but it's Tourmaline. And Mr. Rose, who's the CEO, he just keeps buying stock all the time, every quarter. Like when there's a dip, he's in, as soon as he's allowed to buy, he's in there buying. And so there supports the stock, but it also gives his whole fortune's tied to making the stock go up. So if I like management from what I see and they're a buyer and a big holder, then that also helps. So just any little extra thing like that. You can, the problem is it's a while ago now, but you can look to what has the company, even if the management changed, what's the company done in the last downturn, like the last recession? Did they survive? How did the business go? Was the balance sheet good enough that they didn't get in any trouble? In fact, were they smart enough to maybe make an acquisition when somebody else was in trouble? So some of that's anecdotal and not numerical. But after you've done all of the numerical stuff, the balance sheet and earnings growth, and I would like a company to pay a dividend if they can, but there are some businesses where it's maybe if you're in a high growth phase, maybe it's not so appropriate and you'd eventually pay one. Back to that Tourmaline example, they do pay a dividend. In fact, what they do, which is another thing to look for, is because it's a cyclical business, they pay a small regular dividend and then they pay specials. So if natural gas was up and they made a bit of extra money, they'll give it to shareholders. They'll do a buyback and they paid a special dividend last year. I'm hoping they pay another. I own the stock. I hope they pay another one this December. And I'm hopeful because they're earning a lot. So some of this is all anecdotal. I don't know how. It's difficult. I was going to say, I don't know how people would have the time to do all of that
That's
digging.
the point. That's the
But
point of having a coach or maybe giving it to a reputable fund manager because I would rather not lose my money than pay a small fee if the return is good. Or what I've seen, like you've said, is that the S&P 500, most of the fund managers, they don't beat the S&P 500 index over time. So for me, if I had no idea, even Warren Buffett has said that, and this is not investment advice, by the way, but it's a no-brainer, right? In a way, at least if history is to repeat itself. I was watching a program in Zimbabwe, and one of the speakers mentioned something that I found was thought was profound. He says there's a guy who said those who don't learn from history, they are bound to be punished by it, right?
yes,
So
I've heard that statement. Yeah,
yes.
yeah.
So yeah. So what I've seen is like when I like to look at the data from, let's say, for the S&P 500 or the Nasdaq. For the S&P 500, I think it started trading, I think 1923 or 1928, somewhere there. Don't quote me for it. But what I've seen is there's history that has been repeating itself, right? Like, for example, after a bull run and when the market it drops, a lot of people they lose a lot of money because they panic. And when those with money, they're actually doing the opposite, right? They're actually buying at a huge discount. I saw it in April when President Trump announced the tariffs. I could see the market dropping. I think it was April 7th or somewhere there. And I was talking to my uncle who I trade with. And I was saying, Uncle, I'm deploying capital now. And I was buying companies like Microsoft, Apple. And it's counterintuitive because psychologically you will be like, if you buy, it drops, I'm gonna be losing money. But the thing is like, I started seriously investing in like 2020. And one thing that I noticed is that you have to look past like just what is happening now. But of course, you have to not ignore things that we have mentioned. Like, is this business making money? What is the, like you mentioned the other time, the price to earning growth? That's another important metrics. Cash flow, free cash flows, and all those things. So I know we can talk and talk, but I want to give you an opportunity, Bruce, to share something that you would think would be valuable to the viewers from your experience. Are there any particular things that the audience can probably learn from your experiences?
Well, something really valuable you said there, Isaac, is, and it happens over and over again, is tariffs in April, COVID,
Yes,
2008. I'm
yes,
around for 1987 crash of the hedge fund. It's very difficult to do, but if you can buy when everyone else is selling, and the only way that you can do that without, if you want to sleep at night, is to buy things that you believe in longer term. I think you and I have talked about that a little bit in the last
yes,
few months. Is you buy Microsoft, you know that
yeah,
Microsoft is not going bankrupt next week, or
yes.
Apple. Apple's got, I believe Apple has so much cash, it's like the
Oh,
13th
yes,
largest country in the world by GDP, if you just take
yes.
their cash. So yes, though, it doesn't mean they can't go down, but it means you can sleep at night knowing that
This,
I own a business,
yes,
right? I think of it, you're an owner. You might be a 0.0001 owner, but you're an owner. And back to Warren Buffett, he always said, when the tide comes back in, we see all the people that aren't wearing any pants,
yes,
right?
they are swimming
And
naked.
so what he means is that's when you see all the things that are wrong with a company is when things are difficult. So
Yes,
if you own Microsoft and the tide comes in, you'll see they've still got some pants on, but
yes,
a lot of companies don't. And so I think that if you can do that here and there, and otherwise you don't have to take too many chances to end up with that, probably a better than a 7% compound over time if you can
yes,
occasionally buy when others are fearful. And but you're right, if you look at the broad statistic of investors in the US or North America, most people, I can tell you from a whole bunch of years of particularly the last 25 with individuals, is when everything is going well, clients don't call you. As
yes,
soon as there's something wrong, that's they call to panic. And you can try to talk them out of it the best you can. I remember in 2008, we we talked almost everybody out of selling, but there was one gentleman, he couldn't sleep. He insisted we sell. So we sell and go to cash. And like 9 months later, he calls back and says, "You were right. I was stupid. Next time, don't listen to me." But you have to, again, if you own good companies, then you're always going to be okay in the longer term. And this doesn't apply if you're 63 years old already, obviously,
yes,
because you don't have very much time and you can't make up for the lost time. But you can
yes.
make up for, if you're young, you can make up for almost every mistake because you just have
Yeah.
time to make up for the mistakes. So.
Yeah, I know we are running out of time, but one last thing that I wanted to ask Bruce is that, I mean, if you're comfortable sharing, like how much cash do you keep in the portfolio? Like, do you have a specific formula or you just keep however?
So not a specific formula, but I would always keep some minimum of cash for new ideas. So, but
Mhm.
that would be sort of, let's say, 3 to 5%. So you'd
Okay.
always have at least that, so
Mhm.
you could react to
Yes.
something energy stocks are the opposite. Trump does something and they're down 10% and you really like them and you want to buy. If you have some cash, you don't have to sell something to buy it. I think this is another lesson is you try to be humble. Like I try to think I'm not smarter than the market, even though I've got lots of gray hair and been doing it forever. The market's always right eventually. So I would never go to 50, 60, or 80% cash. I would change the type of thing I might own and have a big dividend paying stock. Or I was telling you, unaffiliated. I've owned some Campbell soup here lately because it's a comfort stock that just doesn't go down much ever. And it's been pretty weak lately because it's out of favor. It's just too conservative. So own that and get the 4% dividend, and you'll end up with more than your 7% compound. And so that's sort of like a cash replacement. So for me, I sort of 3 to 5 when I really like everything, and I would go up to 20 or 25, but I wouldn't go much higher than that. But if I was 25 cash in the 75 that I owned, I would be much more conservative than I might be if, like I am now, and unless I thought the market was going to go up. I think it can keep going here for a while, but at some point there's probably a pretty big correction coming. I don't mean a crash. I just mean some kind of 10% correction. And if there's a 10% correction on everything, it'll be 20 on tech stocks and 5 on the stocks that I own, but then I'll put some more cash back in.
Okay, that's interesting. So thank you so much for the privilege of your time. At some point, probably we can bring you back so that my audience will learn from your decades-long experience. And like I always say to the audience, the best thing that you can do is to educate yourself. So with me bringing people who have managed billions and people who are actually managing their own money, my goal is to help you guys get some insights from these people who have experience. So I hope I will be able to catch you in the next one. Make sure you subscribe and follow me on social media. Thank you again, Bruce.
Hey, no problem. I've really enjoyed it, Isaac. Thank you.
Thank you.